Good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development here at SVA Certified Public Accountants. I'd like to welcome you to our webinar today, where the topic is investing in vacation rentals, opportunities and risks for dental professionals. So our presenters have a lot of information to cover, so I don't want to take up too much time, but I just want to take a sec before we get started and say a few words about SVA and our history working with dentists. So we've been around now more than 50 years, and throughout all of those years, we've been working with dentists. One of the main reasons for that, I think, is our consistent goal of remaining independent. And by helping dental practices with profitability, growth, and overall business strategy, we help position them to remain independent as well. Our mindset is that when you're a practice owner or shareholder, you have to work with someone who's more than just an accountant or a tax preparer. You need someone who's working collaboratively with you. Information like what we're going to be sharing here today is just one small way in which we do that. So as far as today's webinar goes, if you have any questions as we go, please send those in via the chat function. We are going to save those for the end, though. And let me introduce our speakers. So we've got two of the most experienced people in our healthcare and dental practice to walk you through everything. We've got James Emmerich, or JD, and Matt Vanderloo. They are both principals here and have been very involved in working with dental practices over the last, I don't know, I'm going to say 20 years. Matt is also SVA's CEO. They both work with practice owners and practice managers on efficiency, tax, and profitability strategies. All right, so let's jump right in. JD, you ready to kick this thing off?
I am. Thank you, Lee. And thanks
Awesome.
everybody for joining us. So when we sit down as a group and we talk about topics that we want to talk about with our clients or prospects, something that seems to be a new recurring theme has been short-term rentals. And so we decided let's spend some time and do a webinar about the short-term rental activity and how it can be beneficial. It's going to be kind of heavy tax focused, so I do apologize for that if you're not a fan of tax. But it's really important because a lot of the advantageous tax breaks that you're looking for are all going to be based on certain tests and conditions that the IRS has set. So you got to make sure you understand them. There's a lot of misconceptions and pitfalls out there where somebody might read something on a blog or a buddy tells them something and they start to look into this. And next thing you know, we get a call that says, oh, I'm going to buy a short-term rental because I can maximize deductions and offset my income. And there's opportunity to do that, but it's not as simple as just buying a rental property and saying, now I'm going to deduct the losses that it's going to generate. So our goal today is to help clarify or clean up those misconceptions, kind of walk you through the different conditions and tests that are out there so you can see if you qualify for the favorable tax treatment, which what we're really shooting for is we're trying to get to non-passive treatment of the activity, okay? So before we can do that, we're going to talk about the key questions that we need to answer, okay? So first, is the activity considered a rental under IRS rules? Well, the way that question's phrased kind of sounds a little goofy because we're already calling it a rental property. But by design, real estate is passive in nature. The IRS says real estate is passive, and then there's certain hoops you have to jump through to show that it's not necessarily a passive activity, okay? So we're going to evaluate those. There's 6 different conditions that we're going to consider. The second one is, does the taxpayer materially participate in the activity? There's 7 different participation tests that we'll go through. And again, we'll spend a little bit of time in detail on those so you can kind of see what they are and whether or not you check the box to qualify. And then once we get there, now we can make that determination of whether or not it's passive or non-passive, okay? And again, the main goal here in all of this is that we're trying to target or achieve non-passive treatment. That's the most advantageous for the taxpayer. If you do generate a loss from this activity, non-passive status allows you to use those losses against ordinary income. So now you're starting to offset your W-2 income, for example. Okay, so that's really what we're shooting for. So let's talk about the 6 different conditions where the IRS considers the activity to not be considered a rental property. Okay. Most important thing here is if you meet one of these, you move on to step 2. So you don't have to satisfy all of these listed on your screen. We're just trying to target one of them. So first one, average customer use is 7 days or less. That's exactly as it sounds. If somebody's renting your property for 7 days or less, or when you look, I shouldn't say somebody, if the period or duration that on average the customer is using it 7 days or less, you satisfy condition number 1 already. Condition number 2, average use is 30 days or less and you provide significant services. So examples, you're providing the cleaning during the stay, concierge services, meals, transportation, daily maid service, okay? You do that, you satisfy condition number 2. It does not include basic utilities, trash collection, routine maintenance, common area upkeep. None of that qualifies. So again, it's those things that you're providing significant personal services for. The third condition, you provide extraordinary personal services. So that's nursing care, assisted living facilities, on-site medical services. The fourth one, the rental is incidental to a non-rental activity. What does this mean? Think about that one as you're buying property and you're holding them as inventory, so to speak, because you plan on selling that activity in the near future, okay? But while you own it, there is a rental activity occurring on it. So that's incidental to the end goal of what you're trying to accomplish by holding that property. So in theory, then you would satisfy the fourth condition. Condition number 5, property is available for non-exclusive use during business hours. That one, the best way to kind of describe that one would be you own a building, an office building, and you're renting out conference rooms, okay? And then the last condition, property is used in non-rental activities, so partnerships, S-corps, joint ventures, etc. Okay? So what does that mean? You look at these 6 conditions, and then we got to evaluate, did you pass or did you fail? If you've passed, if you've satisfied any one of those conditions, it's not considered a rental, and we get to move to step 2, which is now we start talking about material participation. If you didn't satisfy any of those 6 conditions, it is a rental. It's going to go on Schedule E. And now we're into the passive status. And the pitfalls of passive status is the activity, any losses generated from a passive activity are either suspended or they're used only against other passive income, okay? So again, this is kind of a tax focus, but there's pitfalls if you're reporting it on Schedule E. So ideally, we'd love to get you up to Schedule C, which is trade or business, and proceed as a non-rental trade or business here, and start to look if we can material participate and get some of those losses if the activity is generating losses, okay? Step 2, material participation and why it matters. So again, this is going to be the crux of kind of the whole deal. There's 7 different tests. If you pass one of them, if you satisfy one of the tests, you material participate. And now we're talking Schedule C, trade or business, and we're feeling good, okay? This is going to determine whether or not losses can offset other active income or if the losses are going to be suspended. Again, I'm going to hammer it home. The goal here is to achieve non-passive status. Material participation opens the door for the more favorable tax treatment, allows us to possibly deduct losses against our ordinary income, while passive is subject to limitations. Any income that generates from a passive activity is ordinary and subject to ordinary income rates. However, the losses that are generated can only be used against passive income. If they exceed passive income, then that gets suspended and carried forward indefinitely until you either have additional passive income or until you dispose of the entire activity. Okay? So, material participation is a real thing. It's very important. Let's take a look at the tests. So, 7 tests. You only have to meet one of them, very similar to the conditions on a couple slides previously. And it's important. You'll see there's hours being listed here, okay? The hours that you're starting to see can be combined with your spouse, okay? So important as you go through this and you start to track your own hours in your mind, what does it mean? Well, it means yours and your spouse. So if you're both tag teaming and doing certain things, document them both, combine them, and it might help you achieve some of these tests, okay? These first 3 that are listed are the most common. Number 1, greater than 500 hours of participation. And again, this one is exactly as it sounds. If you have more than 500 hours of participation in this activity during the year, you meet test number 1 and you material participate. Test number 2, participation is substantially all the participation. So this means your participation is substantially all of all other individuals, including non-owners. So for example, if you're spending 400 hours handling the books doing the cleanup, you're doing repairs, you're talking to potential customers about stays and answering questions, and then you hire a contractor who does 30 hours of work because there's something that you can't do on your own, you've satisfied that requirement because you're doing substantially all the work there. Okay? Third test, greater than 100 hours and at least as much as any other individual. If you participate more than 100 hours and no one else participates more than you, you've now satisfied test number 3. Okay? Again, we're trying to satisfy just one of these tests, and there's 7. So on the next slide, we'll go through 4 through 7. Number 4, significant participation activities totaling greater than 500 hours. So this is considered the SPA test. It means that you can participate in multiple activities and combine the hours that you're spending to try to achieve that 500 hours. You have to do at least 100 in each of those different activities. So think of it as multiple properties that you have. If you're spending at least 100 hours in each and combined, you're over 500 hours, you would satisfy test number 4. Test number 5 is kind of a look-back test, materially participated in 5 of the last 10 years. Test number 6, personal services. So this is really not real estate related, but this one says if you materially participated in the prior 3 years. So think about this one as a dentist who was full-time and now they're starting to retire and they're slowing down, but they're still an owner. So do they or do they not still materially participate in that activity under material participation tests? That would say yes. So again, not necessarily real estate related, more personal services driven. And then last but not least, number 7, facts and circumstances showing regular, continuous, substantial involvement. You can't meet test number 7 with less than 100 hours. Management time doesn't count. This one gets audited, or at least is a red flag more often than not. It's a facts and circumstances. The IRS always wants you to show. And so if you try to use this test, certainly could open yourself up for scrutiny. And the burden of proof is always on the taxpayer. Okay, we ran through the conditions, we ran through the tests. Next, I'm going to turn it over to Matt, who's going to run through what counts as participation.
Great, thank you, JD. Now I think I've got it all. Okay, there goes the camera. Great, I've got it all working. All the technology's on my side. JD, so as we think about those 2 tests, that 500-hour test, that 100-hour test, what actually gets us there? What counts as hours for those? And it's not just as simple as everything I did that maybe kind of tangentially somehow I think is related to this rental activity. The IRS gets a little bit more specific about what they're going to count towards those hours requirements. So some of the things that will the hours really that you're working to operate the rental or manage the rental. And that can look like a lot of different things. It can be approving expenses. It can be handling operations, things that are management type decisions, supervising any employees you might have, supervising contractors, actually doing repair work, cleaning work, the time you spend booking it, the time you spend advertising, marketing it, dealing with customer complaints and customer questions. All of that's going to count towards your participation hours. And one of the great things that can work in your favor is if you're a married couple, the spouse's hours also count there. So we can aggregate your hours and the spouse's hours to try and get to that 500 hours or that 100 hours. There are things that on the surface might seem like they count towards those hours that the IRS doesn't actually count. So anytime you're commuting between your home or your business and that rental property doesn't count towards that hours test. We can still deduct the mileage that you're commuting as an expense in that rental, but we can't count the hours sort of the test. If it's work done just as an investor, so if you're educating yourself about rental properties, if you're doing research on it, rental properties, maybe where to locate one that you do as an investor, that doesn't count. If you're just reviewing financial statements as an investor, that's not going to count. And then any activities that you're coming up with that you think relate to the rental that you're only doing so that you can get to 500 hours or 100 hours, the IRS isn't going to allow those either. So we've got to be a little bit careful about what we count towards those hours. What we really have to be careful about is how are we keeping track of those hours? If this ever becomes an audit issue with the IRS is really going to look at the documentation around those hours and how you came up with what you did. Any kind of records we have are going to be great. And the more detailed the records are, and the more contemporaneous the records are. So the more you did the records as you were recording those hours, the better it's going to be if we have to get in front of the IRS. So we might look at appointment books or calendars or any kind of narratives you write up, any time logs you keep are going to be helpful in getting us there. What the IRS is really going to look for and really going to frown upon is if you've included commuting hours as participation. They're not going to allow those. Anything where it looks like you've inflated the time, if you've really exaggerated or spent an unreasonable amount of time booking reservations for a few stays, they're going to look at that and throw some of that time out or all that time out. If you're inconsistent in reporting things, they'll look at that unfavorably. If you're recreating all of your time logs when the audit starts, the IRS tends to not like that as well. So everything you can be doing to keep track of this as you're actually incurring the time is going to help you if it ever becomes an issue. The great news is that there are a lot of different apps that you can get on your smartphone. They're going to help you track all of this, whether it's actually just tracking your miles back and forth or the days you're actually doing work and what kind of work it is. So you've got great contemporaneous records to keep track of and get in front of the IRS if necessary. So if we don't meet that test to not be a rental activity and to be something that we can report on Schedule C, what happens and where does that leave us? That leaves us then with a rental property and rental activity that's going to get reported on Schedule E on your individual return. And any losses that you have from that activity are going to be classified as a passive loss. Any income you have is going to be classified as passive income, which, depending on the tax result we're trying to leverage out of the system, is not going to be the result we want. JD talked through this a little bit, but if we can get that loss, if we have a loss that we're generating from the rental property, if we can get it on Schedule C, that loss is going to be there to offset other income on your return. W-2 income, other flow-through income from the practice, we can use the rental loss to offset that, which is great, potentially, if that's the goal we're after. If we want to get those losses right now to offset that other income, getting it trapped as a passive loss is going to do that for us. If it's a passive loss, it's going to sit on our return until we have other passive income to offset it. That passive income could be other rental properties, other investment type activities, or it could be in a future year when we have passive income on that same property. Or that passive loss is going to get freed up when we dispose of that rental property. So if our goal is to offset current income, we want to find the rental property, meet the test that it can go on Schedule C and be currently deductible. If we have a different goal, maybe we're trying to get ourselves into that passive income situation, that passive loss situation. And the example there might be if we want to build up passive losses so that someday in the future, if we have a big spike in income, say if in a year when we sell a practice and have a bunch of income from the practice sale, we could be building up passive losses here in the interim that we can use to offset that big income by disposing of that rental property the same year we're selling the practice. So depending on what we're trying to accomplish, it's not necessarily that we have to absolutely avoid being passive on the loss. We have to think about what the goal is with the loss we're trying to accomplish and try and leverage ourselves into that situation. So as we try and pull this all together into one step here, or one process here, step number one is going to be back to those first set of tests that JD talked about. Can we get this qualified not as a rental? Does it have short customer usage time, short customer stays? Does it look more like, I would say, a hotel? If it does, then maybe we're not a rental, so that gives us a lot more opportunity to deduct those losses. Potentially, if we can meet on step two, do we materially participate in that activity? Are we really active in that as a business idea, or are we just an investor who's passive and has somebody else doing everything for it? If we can pass both those steps, we go right to Schedule C with that loss. It's a non-passive loss. It offsets other income on our tax return, which is a great result. If we can use those losses right now to get the tax benefit. If we miss on either step one or step two, or if we miss on both step one and step two, that activity is going to go to Schedule E. It's going to be passive. Those losses we have then are going to accumulate as passive losses. We can use them to offset other passive income, or we can use them when that property is sold. That's going to free up all of those losses. The other wrinkle we have in here that kind of relates pretty well to the rental ideas, we've got this special rule called the Augusta Rule. I think clearly came out of Augusta, Georgia, clearly relates to the Masters Golf Tournament down there. And it allows us a specific exemption on rental income from the rental of a residence if it's a very short, limited number of days that it's rented during the year. So if you're renting your personal residence or a second home, vacation home for 14 days or less per year, we can exclude the rental income from that property from taxable income. So it's an opportunity for you to generate income that the IRS says does not have to be taxed, which is a pretty unique kind of income. Usually almost every other form of income is going to get taxed one way or other. The common way we see this used a lot is for business meetings. So if somebody has a vacation home, lake home up north, they might take the office or the management team from the office up there for a couple days of strategic planning or other business meetings. And if we meet a couple tests that we're going to go through, practice can pay rent to you individually. Practice gets to deduct rent expense. You individually don't have to pick up that rental income. So it's a really nice loophole. Isn't quite the right word, but I'm going to go with loophole for today in that rule. So the few different tests we have to look at there, is the property rented for 14 or fewer days during the year? If it is, we qualify. Is the rent we're charging at fair market value? And the bigger risk there is not being under fair market value, but is being over fair market value, charging yourself excessive rent when you're going to get to deduct the rent and not have to pick up the income. Is there a legitimate business purpose? Was it an actual meeting? Was there an actual reason we were using it for business, or are we just trying to create a deduction? You have to actually make the rent payment, record it in the practices being paid, and keep record of receiving it on your end. And remember that if it's your personal residence, that personal use for the other 351 days out of the year does not disqualify you from taking advantage of this exclusion. Can be an area that the IRS is going to look at pretty aggressively. So some things we want to make sure we're doing here, the best practices to be ready if there is that audit, some sort of written rental or meeting agreement that spells out what the fee is going to be, what that rental cost is going to be, and everything else that goes along there. Keep records of the actual meeting that takes place so we can make sure we can demonstrate that business purpose, the agenda, the notes, maybe some photos of your staff and you up there for that strategic meeting. Whatever research you're doing to help establish that fair market value for rent, make sure you're keeping that so we've got that to show the IRS if that becomes an issue. And then make sure that rent gets paid over and that the practice is recording the expense. That's half the benefit we want to get, and that you're picking up that in. You don't have to report the income on your return, but you're making note of it in your records. Because the income's not taxable, we don't have to worry about calculating depreciation. We don't get to take any rental expenses. Since we're not picking up the income, we don't get any of the expenses. So there's no additional work there, nothing we need to worry about there. The big risks here again, if you're charging excessive rent, if fair market's $1,000 and you're charging $10,000, the IRS, if they find out about that, if they audit it, they're going to throw out at least the $9,000 of excessive rent. If you don't have the documentation to support the business purpose for the meeting, when it happened, things like that, that's going to be a big red flag. And then exceeding the 14 days. And this is, remember, this is not a proration kind of a thing where if you rent it for 20 days, we can throw out the rent for the first 14 days. If you go over 14, all the rent that you picked, that you could have excluded, is now included as taxable income. So you have to be very careful about that 14-day threshold and make sure you're staying well under that. So that's a really quick, we flew through that on all these different rental topics. But I'm getting us done hopefully in time that we can get to all the great questions we've had come in too.
Absolutely, we did. We have gotten a ton of great questions. Surprisingly, nobody's asked about what it is you're wearing, which I think needs to be addressed. Matt, right. What's going on there?
Well, I'm visiting our Brookfield office today. We normally work in our Madison office, and I really wanted to do everything I could to get everybody in the holiday spirit. And burn some corneas during this webinar. So I've got this beautiful red, white, and green holiday themed suit on. So my apologies to the viewing audience there who wishes
everybody
this was
who
a podcast.
Yeah, maybe in post-production we can we can use AI to put a normal suit on you.
Probably a good idea.
All right. Well, no, you guys, great information. And, I will I will admit, when we came up with this topic, and JD, I think you were kind of the one driving this, I was like, really, guys, is this really a topic that dentists are going to want to hear about? And I think not just because of the number of people that signed up, but the number of questions we've gotten, like, this is clearly an area of interest. So let me start here, though. We have had a few questions come in, which we'll get to, but guys, there's a lot of talk about that. I'm going to want to make sure I use the right word. So the material participation. And there's a ton of stuff online. If you're on TikTok or you're looking at your Instagram reels, you're going to hear influencers talk about how everybody can take advantage of all this stuff and all these opportunities. But you guys you've gone through the rules. What's the reality of the situation if people start claiming this stuff and they can't substantiate it?
Yeah, I can jump in, and then Matt, you can add whatever you'd like to add. I think it's important to remember that the burden of proof is always on the taxpayer. So if you file a tax return and you're claiming that you can take a deduction, you have to be prepared to substantiate your stance or your status that you elected to the IRS. The burden of proof is not on them to prove that you don't meet these tests. It is on you. And it is certainly an area that gets scrutinized. And we're seeing more of it as, short-term rentals become more popular. Matt, I don't know if you had any additional comments.
Yeah, I think the only thing I'd add to that is, worst case scenarios, the best worst case scenario, if that makes sense, is that the IRS is going to disallow the loss you claimed and say it should have been passive, you should have suspended it, and you shouldn't have deducted it on that 24 return. And the IRS is going to send you a bill for the tax you owe, and then interest for late payment and maybe some penalties. That's the best worst case scenario. The worst case scenario is that the IRS is going to contend that you were malicious and you had wanton disregard for the tax rules, and they're going to throw additional penalties on top of that for what you did. And it's going to add up quickly and it's going to be painful.
Yeah, and oftentimes we're forced to be that middleman where people are seeing this stuff online. They come to us and go, "Hey, I found this loophole. Let's go do it." And it's like, I know you guys are always in the difficult position of educating people and not always delivering information that they want to hear.
Right.
Yeah. All right. So let's jump into some of these questions. So first one that came in was, I'm going to read this first part. Great topic. I love this. I have 7 short-term rentals. My accountant says it doesn't matter if they are on Schedule E or Schedule C. Is that true, or should I be looking for a new accountant? And let me answer this, number one, from a sales perspective. If you're not working with us, look for a new accountant. But maybe you guys give them the real answer.
It certainly, as we've kind of gone through, it certainly does matter, Schedule E or Schedule C. Once it's on Schedule E, you're reporting it as a rental activity as opposed to considering it to be a trade or business. So, if you have multiple short-term rentals and you feel like you're meeting the different criteria that we outlined, the conditions and material participation tests, if you feel like you can easily, or at least you do believe you satisfy those and you think that you should have a different look, it would certainly behoove you to reach out and get a second opinion. I would never say go and just fire your accountant, but it doesn't hurt to have a second opinion. I'll leave the sales pitch for Lee, but certainly it helps to have somebody else take a look at it and see where you qualify and where you can land.
The other piece I'd add to that is today we focused a little bit more on the loss side of this. If you've got a loss from that rental property, what are the advantages of being on Schedule C or Schedule E? If you're in the opposite situation and your short-term rentals are generating income, it is, in my mind, still incredibly important that we think through this and get it in the right spot, because there are different impacts and different kinds of not income taxes, but other add-on taxes like the net investment income tax, self-employment tax that we've got to think about and be cognizant of. And there are other additional tax benefits we might be able to wring out if you're making profit on these and it's on a Schedule C as opposed to a Schedule E. So regardless of whether you got income or loss, I think it's really important that we get it on the right form and take advantage of all the opportunities that come with that.
So, Doctor, I see your notes coming in. We'll talk. So next question was, my accountant says that I'm phased out of these losses from my rental. My AGI is around 450,000.
Yeah,
I think.
Go ahead, man.
Let me go first on this one, James, and then you can tell me when I'm wrong.
Okay.
I think since you're saying phased out, I think what we're talking about there is a provision that allows taxpayers to deduct up to $25,000 of passive losses from a rental activity if their income is under a certain limit. So there is a carve out there, and that income limit's pretty low. I saw this question came in, so I was Googling it. And if your income is less than less than 100,000, you get the full $25,000 deduction. If you're between 100,000 and 150,000, you get some prorated amount down from that 25. And if your adjusted gross income is more than 150,000, you're phased out of getting that $25,000 deduction. So I think that's what that question was about. That doesn't mean though that if it was active, you would be able to deduct it, or if you've got other passive income that you can offset with those passive losses, you don't have to worry about that income phase out. So I think that's what they were asking about. If that's not what they were looking for, chat us in a little bit more detail, and we'll get to the real issue we're trying to get to.
Okay, last question we want to cover here. I know we're already a minute over. Is I was told that travel hours to out-of-state locations count as that is not where the primary business is located. That might be a stumper. What do you guys think?
I am not aware of a carve out for travel if the rental property is out of state as opposed to in state. My read of those rules and my understanding is that travel time is travel time, and it doesn't count towards your material participation hours. It doesn't matter if it's next door, across town, or across the country.
Yeah, I was going to say, I think we need to look and dive into the rules a little bit more. That's where I would leave it. We'd have to evaluate that one a little bit further.
Okay. Well, you guys, like I said, we're already a minute over. You guys have done a great job of getting through a lot of content, and clearly very of a lot of interest to people. So as we wrap up, I just want to point everybody to sva.com/OBBA. That's OBBBA. There's a ton of information there about the One Big Beautiful Bill Act and how it will affect you. We are right in the middle of tax planning season. So OBBA changed a lot of things for a lot of people and a lot of practices. So if you are not working with a strategic advisor helping you with tax planning, let's talk and see if we can help. Also, please visit sva.com/dental series to see recordings of our past webinars for dentists and to sign up for our upcoming ones. Our next one is going to be next month, January 20th. And the topic for that is maximizing the value of your dental practice. So again, thank you guys. Great topic. Thank you everybody for attending today, and hope you have a great rest of your afternoon. Bye-bye.